When I first discovered the stock market, I was love at first sight. It quickly became my dream to be a professional trader. I threw together a little bit of money to help get me started. You can see that balance over here. Um, Unfortunately, to make it as a professional trader, that's not going to be enough money. Here, then, this raises two questions for me. One, how much money do I need to make to be considered a professional trader? And two, how much money do I have to generate that much? Well, the first question is pretty easy. At minimum, I need to be able to beat minimum wage. So that gives us a total of every day I need to generate about $125 a day. I'm cataloging this journey here on the Russell Journal. I'm Russell, and this is my journal entry for Wednesday, October 9th, 2022. So the question is, how have I done so far this week? Well, over here you can see that I've had a pretty rough day today, down quite a bit. The balance has gone from almost $400 to just under $300, or under $200, $177. You can see that my trading P&L my open P&L is negative $259, and you can see that my closed P&L for trading is negative 100, or is a negative 159. So far, everything I've done in the last couple of weeks has really not worked that well. I'm not that upset about this. To be honest with you, I started here with about $1,000, kind of going through this, testing some things, trying some stuff. I keep thinking I have something figured out, and I obviously don't. That's very clear. The trades do tend to go against me. I've been playing with this idea of the strangle versus the straddle, and both of them seem to have their faults, and some of them have their strengths and their weaknesses. And I'm in a position where the cost of learning about this has kind of made it so I can't continue forward to test a lot of this stuff. We will see. We have CPI data coming out tomorrow morning at 8:30 a.m. I have my last strangle on at this point. You can see that over here. And you can see basically I'm strangling here of the daily chart, the upper and lower Bollinger Band. These two contracts expire on Friday. This last one over here, this little one here at the 402, that's a little bit different trade. That's one that's still kind of being run as far as testing to see what we can get away with from the position of a strangle. This one is from a strangle we held last week, or a straddle. No, this was a strangle we had from last week. We did pay for that call, so I'm holding that call as far as things go, and to see kind of where this winds up and how things go. I am playing with real money here. This is not a paper account. This is real, actual cash. I was hoping that I could really step into the $125 a day quickly. Unfortunately, that just doesn't seem to be happening. Good news is I have backup money. We will be putting more money into the account and attempting to try this again over the next couple weeks or months. We'll bolster that balance back up and see what I can come up with. As far as the elections go, and this is a lot of things that there's a lot of the news that's gone on around the election, is that the Republicans did not get their red wave that they were hoping for. Races are a lot closer, a lot tighter. Last I checked, they got 200 seats and 204 seats in one house, and they've managed to keep it pretty balanced in the Senate. So we'll see how that continues to play out, and I don't know how much that'll actually matter. So as far as all of that is concerned, we will see. I think a lot of hope was around. I don't know if it was hope or hype, right? Like there was a lot of hype. The idea that even if you got a Republican Congress, that he would be able to turn the economic situation around with the Republicans. The truth of the matter is, no matter what happens, they all have to do. It doesn't matter if you're Democrat or Republican in this space. You really have to fight the Fed. You have to deal with the Fed, and everybody right now is trying to find a way for the Fed to continue to pivot, to make money easy and bring back on a time of growth. The problem with that is, until even if the Fed does pivot, you still have high inflation. Yes, you still have that high inflation. So the thing is even if Fed pivot means more inflation and worse and a weaker economy either way. So either the Fed weakens it artificially through raising interest rates, or it just begins to weaken itself through more inflation, right? Either way, this is coming, right? Either way, this recession is going to happen. It's either going to be, an inflation-driven recession that the Fed has no control over, or it is going to be one that the Fed. It's going to be one that's driven from higher interest rates. Either way, which one is better? Well, my guess would be that if controlling a crash is always better than just having it go willy-nilly wherever it wants to go. That's in all honesty, that's what I see, and every time I see it. So now the problem with the Fed-controlled crash is it requires something to break. We don't know what will break. We don't know which part of the economy is going to break in order to give us the recession that will give us the lower inflation, right? We don't know what that is. So there you have your issue. So as to like the controlled crash, you just don't know which part is going to crash. Now we can see from Facebook just laid off 11,000 people. There's some more a lot of tech has been laying off employees, letting people go. So you're starting to see we should really start to see some of those unemployment numbers really tick up. Coming into, I don't think you will see that. You won't see those claims this week, but you will see those claims start to happen next week. Okay, so most of the claims that we're getting are from a week ago. Monday, you file your unemployment claims on Monday, and then the next Monday is when those claims go and get reported. So really, we're kind of 2 weeks in lagging in data as far as those unemployment claims go, and the announcement of those layoffs just sort of happened, and a lot of that's going to be California. Elon laid off a bunch of them on Twitter. Facebook, and so a lot of these Spotify's laid off, Shopify, a bunch of these companies, tech companies, all laid them off. Google search will get you right to that data. So again, we should start to see a nice rise in unemployment. This can give the bulls some hope for a Fed pivot. But that's where one of the other things that I've wanted to talk about this week, and really some of the stuff I really want to talk about this week, is really the idea of what the bulls can do and what the bulls can't do. Okay, so we've talked a lot about the large funds that come in and they buy this market, and they're loading into this bear market. They're taking up massive positions. They're essentially accumulating inventory of their positions through this market. And what allows them to do that is the stability of the cost of money. They're looking for it to stabilize as far as the cost of money goes. That's how their funds work. They're buying based on where and how these averages are. Okay, so what you have is that they're really managing they're managing a cost basis, right? And they really have to do this when times are bad. I think about my father has mutual funds and he has stock accounts, and they are large. My dad has a lot of money. I do not have a lot of money, but he does. And he cannot, even if he wanted to, right? He could have seen, if he had seen, we knew this bear market was coming. We knew last December. And because of the way taxes work, he just has to ride out this whole bear market, right? He can't just liquidate all of his positions. Sure, some stuff he can. He can take some tax loss harvesting and things of that nature. But when you're looking at, and you're looking at things like the baby boomer generation, which is coming into this market and starting to live on their savings and on their investments as their retirement, right? They cannot they can't just dump their positions. They can't just liquidate, right? And this is part of the difference of being sort of a retirement investor versus like, you know, an investor. Okay, so those guys, they really have to maintain their position, and really what they're, you know, and if you're building one of those retirement type positions, you know, you're just dollar cost averaging in. And these major funds that are basically doing that for people, they're bringing those purchases on based around the idea of the cost of money, the stability of money, and that's a large piece of the stuff that flows into these markets. So this is why you also get this is why you get some of the confusion here, right? Don't get me wrong. So let's go back to when we hit the all-time the 4-year low basically of the stock market here at 348. Okay, this was traders. This candle right here was shorts coming out, and this was guys who were traders rallying in. Now, don't get me wrong, there was absolutely some buy the dip crowd in here. But most of your investment guys came in through these points right here, right? They weren't coming in right off of the low. They're not that good. This was traders, okay? Short started to cover. You didn't capitulate within the first few minutes of the market open back here. You know, this is a couple weeks ago. And you got this rally up. So, and off of that, when you came back and you set in a higher low off of this candle, now the bull thesis starts to sort of take shape, and you can get this big move up all the way into FOMC. What happened during FOMC? Oh, the cost of money didn't stabilize. It's still going to be 75 basis points. Boom, massive pullback right there, right? And again, look at where we came into. Came right back into this 18-day moving average, and look where the candles start to go green. Again, they start coming back in to hold this up. And this is two things here. This is some crazy psychopaths that shorted this. I was one of them, and we got that nice big move down, right? And then you've got this guy right here, some short covering into that, and again, there's some guys who they love to squeeze shorts, and they were trying to do that. Unfortunately, this is not a smart time for you to entirely do this, to try and squeeze the shorts, because they really do. In the overarching thing, they have all of this. They got this whole downtrend, and you have to negate that. So you might get a day of play out of here, but that's what you got. And what happened today? Look at this big old red engulfing candle, right? That is pretty bearish. Okay. So what does this tell us about what's going to happen tomorrow? Well, it tells us something we already pretty much knew. CPI is going to be high, okay? And the reason we know it's going to be high is we know oil has gone up, we know gas has gone up, we know that there's not enough diesel fuel out there. So your basic energy stuff is gone higher, right? You also know that natural gas had their really crazy short squeeze. Natural gas has gone higher. Heating oil has gone higher. All of the things that revolve around energy have gotten more expensive, and by a large margin, okay? So with that, we know that just alone, even though core CPI doesn't have energy in it, the things that are around core CPI do have energy in them, right? There's things, buildings, cost of housing, all of that stuff around that has stuff to do with energy and food inside of it. So you don't, and I'm not going to really critique as to whether or not it's better to have a headline CPI and a core CPI, but we do know that those prices have gone up, right? And in a lot of those areas, consumer discretionary has definitely gone up, right? It continues to rise as supplies get tighter, as it gets more expensive to ship things, right? It's going to be, we know CPI is going to matter tomorrow. Now, the thing is tomorrow you will get a move. I am expecting a move massively to the downside. I am expecting a hot CPI. I could very well be wrong. It could be flat. It could be another 6.6% reading, but I'm expecting 6.9. I think the other guys are expecting 6.7. I've heard some guys expecting 7 on the headline inflation. I'm expecting 6.9 to 7.1, somewhere in there. I'm expecting the Fed to have every license, this to give the image of every license to continue to raise rates at a point of 75 basis points. I've seen some economists that have come out and said that the Fed target rate should be 6% for their interest rate. So you've had some of that happen. Again, we don't know. And however, the data we get lags off of the interest rates by about 6 months, relatively speaking. So this CPI is a little ways away. It's 6 months away from like the first couple of interest rate hikes. So we might see some cracks start to form. I don't know that it'll be enough. I really don't. We did get some cracks in the non-farm payroll, but they were very slight, right? The Fed still has a very strong jobs market for which to raise rates into. So I would expect that December, you're probably, as of right now, what this will paint a picture of is a December Fed raising rates by 75 basis points. Now, keep in mind, December FOMC happens after we get the December CPI numbers, okay? So this number I am expecting to make this market sell off. The next one, though, which comes very close, right? We have a pretty good idea of what that inflation is doing. That one I'm expecting that to give you your Santa Claus rally. It would make a lot of sense, okay? I still am expecting a January crash in the market. So a lot of stuff that I've done, a lot of my testing I've done has been around the idea that the crash is coming in January. So a lot of the stuff we're doing here is testing stuff because it is near the end of the year. Tell everybody I hate cryptocurrency. I think that it is a fool's errand. I think that they have tried to convince the world of something that we have already tried. It's in a different package, and I will do a cryptocurrency episode. The other thing is, please like, subscribe, hit the notification bell. It does help the channel out a lot, and I'd like to know that somebody's watching or who's watching, and I can make this better for you through that. So I really hope that you would do that. And the other thing is, I would say you really want to come back. Tomorrow or Friday is Veterans Day. And I have a pretty cool Veterans Day episode planned. I've actually been working on it a little bit today. You're probably going to want to see this one. I'm going to do something for our veterans that I don't know if anybody's ever explained it the way I'm going to. So anyway, I really appreciate you guys. Thanks for watching. Until tomorrow, what do I say? The Russell Journal is written, edited, hosted by me, Russell Lewis. We are produced by Social Media Shows. Our executive producer is Maria Pereza. If you would like to have a show like this, please reach out to Social Media Shows. They can put this together for you. It's very easy. You just show up and know your stuff, and they kind of handle the rest. It's amazing. And until tomorrow, though, pretend I said some type of catchphrase.